We look at something like Palantir, up 500% in 12 months. The most expensive stock on the S&P 500 when you're looking at where it prices versus future sales. Does it seem vindicated to you, these sorts of valuations?
There's absolutely some AI enthusiasm at play here, I think there's some. And I think in this earnings season, we have heard from a variety of companies, not just these mega cap tech companies, that they're seeing early signs of success with AI. AI is helping them run more efficiently. It's writing more and more of their code, something like 50% of code. And it's also helping them hit more shots on target, particularly in marketing. But beyond that, I think when it comes to valuations, you need to, on one end, look at the stability in the core business operations of some of these companies, these mega cap tech companies, which remain highly profitable, and then also some of the upside moving forward in the AI race. And when it comes to the leading mega cap tech companies, at least, we actually think valuations aren't as overstretched because core earnings are so robust and they are actively reinvesting a lot of those profits, that cash flow, into the next paradigm shift. And we're already seeing some early signs of success. These picks and shovels companies, they're also digging for gold and seeing the fruits of that.
Stephanie, when you were last with us in April, it was just after the sort of DeepSeek chaos. And we discussed how the semiconductor industry in particular was in the crosshairs of the administration. A lot has changed since then. Actually, the administration has been very supportive of exporting American technology. But just on the stories we touched on, tariffs on semiconductors and location tracking on chips, there's a risk premium there, is there?
Absolutely. Geopolitics remains a risk. Policy has been a headwind for this sector in recent months and particularly today, but we are seeing a shift from this administration towards a greater appreciation around what safeguarding U.S. dominance in AI really looks like.
Right.
And I will add, outside of these risks around tariffs, what is really promising and quite structural is that you have seen a decline in over 90% around the cost of inference for AI. And that has to do with four factors, HARD. Hardware, the chips themselves have been getting significantly more efficient. Algorithms are getting more efficient, how much data, how many numbers they need to crunch. We're right-sizing models. We now have mini models that we can access. And we've seen this democratization in models, particularly open source. So all of that has led to this pretty remarkable decline in the cost of AI, and I think we need to put that to one side when thinking about these risks for tariffs.
We shall borrow the acronym going forward.
Investors will pay close attention to NVIDIA's data center performance when the firm releases its second quarter earnings on August 27th. The chip company makes money from the selling of its powerful AI processors there, after all. However, chip sales are only one aspect of the data center industry. It also includes some of NVIDIA's most significant yet frequently disregarded products, such as its networking technologies. NVIDIA's networking products, which include its NVLink, InfiniBand, and Ethernet solutions, are what enable communication between its chips, servers within large data centers, and end users to connect to it all in order to execute AI applications. The infrastructure is the most crucial component in the construction of a supercomputer. According to Gilad Shainer, Senior Vice President of Networking at NVIDIA, the most crucial aspect is how you join those computing engines to create that bigger computing unit. That results in some significant sales as well. In the previous fiscal year, NVIDIA's data center revenue was $115.1 billion, of which $12.9 billion came from networking sales. Considering that chip sales generated $102.1 billion, that may not sound like much, but it surpasses the $11.3 billion earned by NVIDIA's second largest division, gaming, for the year. Of NVIDIA's $39.1 billion in data center revenue in Q1, $4.9 billion came from networking. Additionally, it will keep expanding as clients expand their AI capabilities, whether in large data centers or research colleges. By orders of magnitude, it is the most undervalued aspect of NVIDIA's operations. Gene Munster, managing partner at Deepwater Asset Management, told Yahoo Finance. Since networking accounts only 11% of income, it essentially receives little attention. It's expanding like a rocket ship, though. According to Kevin Deerling, Senior Vice President of Networking at NVIDIA, the corporation must operate across three distinct network types in light of the AI explosion. The first is its NVLink technology, which enables communication and performance enhancement between GPUs inside a server or several servers housed in a tall cabinet-like server rack. Then there is InfiniBand, which creates a virtual enormous AI computer by connecting several server nodes across data centers. Next is the Ethernet-connected front-end network, which is used for system administration and storage. According to Darling, those three networks are all necessary to construct a massive AI-scale computer, or even a moderately sized enterprise-scale AI computer. However, all of these different connections serve purposes beyond facilitating communication between chips and servers. Additionally, they are designed to enable them to do so as quickly as possible. A number of servers must be able to communicate with one another instantly if you want to use them as a single computing unit. The entire procedure is slowed down when there is insufficient data reaching GPUs, which affects the overall efficiency of a data center and delays other activities. Munster clarified that without networking, NVIDIA is a completely different company. Without their networking, the output that the buyers of all the NVIDIA chips are hoping for would not be possible. Additionally, it's becoming more and more crucial to make sure that GPUs are in sync with one another as businesses continue to create larger AI models and autonomous and semi-autonomous agentic AI capabilities that can carry out activities for users. This is particularly true since inferencing, or the process of executing AI models, calls for more potent data center systems. The concept of inferencing is at the center of a significant reorganization in the AI sector. It was believed at the beginning of the AI explosion that executing AI models would be slightly less power-intensive than training them, which would require extremely powerful AI computers. When DeepSeek announced earlier this year that it trained its AI models on less than top-tier NVIDIA chips, it caused some anxiety on Wall Street. The idea at the time was that NVIDIA's expensive, high-powered systems wouldn't be necessary if businesses could train and operate their AI models on chips with less power. However, as chip companies noted that the same AI models benefit from operating on powerful AI computers, which enable them to reason over more information more quickly than they would on less sophisticated systems, that narrative swiftly changed. According to Darling, there is still a misconception that inferencing is simple and unimportant. As we go toward an agentic workflow, it turns out that it's beginning to resemble training more and more. Thus, each of these networks is significant. For inferencing to be a positive experience, they must be firmly tied to the CPU, GPU, and DPU data processing unit. However, NVIDIA's competitors are circling. Cloud behemoths like Amazon, Google, and Microsoft are still working on their own AI chips, and AMD is trying to take a larger piece of the market from the corporation. According to Forrester analyst Alvin Nguyen, industry organizations also have their own rival networking technologies, such as UA-Link, which is intended to compete with NVLink. However, NVIDIA remains at the forefront for the time being. Additionally, NVIDIA's networking division is almost certain to continue expanding as long as computer behemoths, researchers, and businesses continue to compete for its processors. So what implications does this have for NVIDIA's stock? Let's explore that. But first, a big thank you to those of you who've stuck with us this far. Creating these videos takes significant effort and dedication, so if you're enjoying the content, please hit the like button, subscribe to our channel, and share your thoughts on NVIDIA stock in the comments. Your support truly helps us grow. Now, let's get back to the video. Cathie Wood is having a great time. Right now, growth equities are rising, which is ideal for ARK Invest's co-founder, CEO, and chief investment officer. Over the last 3 months, her greatest exchange-traded fund has increased by 42%. And over the last year, it has increased by an astounding 79%. ARK increased her investments in NVIDIA by purchasing shares. Later this month, NVIDIA will release its profits. Let's examine it more closely. NVIDIA. Wood's addition to the most valuable corporation in the world based on market capitalization is not shocking. An emerging trend among aggressive growth investors is artificial intelligence, AI. NVIDIA is a real example of how sometimes the most obvious option is the best one. Because of its early dominance in graphics processing units, GPUs, it now produces the most widely used processors for data centers that use generative AI. Since plunging 3 months ago, NVIDIA's stock has more than doubled, making it a 15-bagger over the last 5 years. Last week, the stock reached yet another record high. It's the first firm to reach $4 trillion in market capitalization, but it's not the only one currently. Before the month ends, NVIDIA will release an important financial report. When the fiscal second quarter results are announced on August 27th, there are a lot of expectations. Analysts predict that NVIDIA's revenue will reach $45.7 billion, a 52% increase. Their goal is to increase earnings per share by 47% to 1. Although it's not ideal to have the top line surpass the bottom line, NVIDIA is managing the trade war's current restrictions while its products are in high demand. In anticipation of a relaxation of export restrictions into China, NVIDIA is currently beginning to accumulate H20 chips. NVIDIA is currently trading at 31 times its anticipated earnings for the upcoming year. Although that's a hefty multiple, it makes sense if NVIDIA can maintain its rapid growth pace. The fact that you could have purchased the identical stock 3 months prior, when its projected earnings multiple was in the teens, is even more amazing. Analysts are rushing to stay ahead. Last week, Morgan Stanley increased their target price for NVIDIA from $170 to $200. Other Wall Street experts are likely to do the same in the weeks leading up to NVIDIA's quarterly report. Morgan Stanley, which is currently trading at $170 with the stock up about $10, is one of the numerous bulls with price objectives below where their shares are currently. Amid growing tensions over U.S. intentions to include location tracking into AI processors, Chinese internet regulators called in NVIDIA last week over its older H20 chips, citing nebulous security dangers. Analysts think it's more about messaging than H20, even if no ban was imposed. Beijing is using NVIDIA to send a message that it will not tolerate hardware backdoors. Quickly, NVIDIA replied, "No backdoors, no spyware, no kill switches." Although they haven't yet had direct discussions with NVIDIA or AMD, U.S. officials have acknowledged that they are investigating hardware and software solutions for chip traceability. The stakes are rising behind the scenes. Beijing wants leverage and Washington wants stricter enforcement of export controls. H20 chips give both sides a negotiating chip. There is still disagreement among U.S. politicians over whether to increase limits or find a compromise. According to Trump's team, access to rare earth elements is already on the table, and a larger agreement with China is extremely close. However, Chinese state media referred to the H20 as castrated, suggesting that the U.S. changed its strategy because China's domestic AI chipmakers were catching up, not to please Beijing. Following the NVIDIA announcement, investors placed bets on faster domestic substitution, which caused Chinese chip stocks like SMIC and Cambricon to soar. According to analysts, China may now use NVIDIA as leverage to accelerate its drive for technological self-sufficiency or to demand additional supply guarantees. It is unclear if the U.S. will move forward with the Chip Security Act. However, this battle is far from over, with a fall summit approaching and AI supremacy at stake. Don't forget to share your thoughts and experiences in the comments below. Your input helps create a more knowledgeable community where we can all learn and grow together in the world of investing. Stay up to date with the latest market trends, insights, and key updates by subscribing to Investing Tutorial. We're here to help you make smarter investment decisions and stay ahead of the curve.
What I've wanted to ask you for a really long time, is there an America Inc. trade going on here where you just say, I bet on these companies that are most likely to succeed if this American strategy pays off?
I think it's a really interesting point, particularly in the context of this debate around U.S. exceptionalism. Because when I look at the markets right now, I don't see so much U.S. exceptionalism, but exceptionalism from a few U.S. companies. And that is really what is driving the markets right now. We're actually less concerned about valuations for, let's say, the Magnificent Seven, and a bit more concerned about the other 493. Because without that structural tailwind when it comes to AI, it's a bit harder to see the cyclical tailwinds for the rest of the market. But when it comes to these leading tech companies, I think you do have unprecedented fundamentals and the continued dominance, particularly in tech services. Now, there's plenty for investors to consider, and we still think portfolios should be diversified. But at a time like this, you maybe don't want to be diversifying away from that epicenter of innovation.
Okay, so interesting that you got the acronym HARD. Hard tech is where everyone's looking at from a startup culture, but also into these big Magnificent Seven. But then drip feed it down into where, if you are going to diversify, the sectors that are deploying it right, or indeed is it more about the picks and shovels a little bit more? It's about the energy, it's about the infrastructure and that side of the equation that keeps you in the AI spin.
Absolutely. The AI value chain is continuing to expand. We think that infrastructure layer is huge, and that is a secular story that is still in its early innings. The amount of energy that we're going to need, the investment that we're going to need in a variety of different sources, and also everything that goes into those data centers themselves, the cooling equipment, the server technology, and so forth. So we still think there's a significant investment case there. But what's also really interesting, particularly what we're seeing in private markets this year, is this explosion of AI applications, the kind of applications that businesses are going to need, because it's not enough to give their workers ChatGPT. They need domain-specific AI applications that are actually productivity enhancing and show up in the bottom line. We're seeing more and more of those come to market this year, mostly in private markets, but I think that's a trend that is worth watching and just getting.
As we head into the close, what are you keeping the closest eye on?
Yeah, I mean, obviously we've had a really strong day today just in general, but we have been kind of flagging out a bit here. If you're kind of looking at what we highlighted earlier this morning, two key areas that we actually did hold, both for support and resistance. The 6,300 level, a very key area for us to be able to hold, not only just because of the psychological level, but also because of several moving averages that are sitting in around that 20-day moving average here. And we were actually able to open up, kind of test it a little bit, come back, retest. You get this double bounce in the intraday session, and you had buyers stepping in. That's really what you want to see if you are a bull in this market and continuing to see breadth expand. But what we're looking at going into the close is going to be a little bit difficult to try to get over the 6250 or 6350 level. Can we get over it? Yes, obviously anything is possible. But if you're kind of looking at the overall amount of exposure there because of the options that are expiring today, just the 0 DTE, you're actually looking at an estimated $220 billion worth of exposure. Wow. So it's a lot of exposure. For us to break above it, anything can happen. Obviously going into the close, can we ramp up? But I would look at the 6360-ish area to the upside as your potential breakout. Any type of failure below here, you could see that channel that we have on this chart. If we go back into that channel, obviously that would be healthy into the close. And then hopefully we just don't see any type of round trip or a massive unwinding going into the close. So a healthy day, looking like a flag here. Maybe we try to break out. It's just going to be a significant level. This is probably the biggest gamma wall, if you're looking at the calculation, that I've seen over the last couple of weeks. Even though I was on vacation, I was definitely following it and trading myself.
And what do you think is creating that biggest gamma wall that we've seen? What is the primary reason behind that?
Yeah, you just have a lot of call sellers in the market. Obviously, we have call buyers as well. There was probably a lot of buyers over at the open once you hit that 6,300 level once again, kind of trying to move higher here. But you also have a lot of portfolios and institutions that are looking to try to bring in premium every single day. And by doing so, they look at these key areas, 6350, they try to bring in some premium, and it creates this kind of wall at the top of the market here. Once again, can we break above it? We can, and sometimes when we do break above these very key areas, you're talking about $220 billion worth of exposure potentially there. Once you do break through it, especially going into the close, you can see a significant ramp to the upside. But right now, what dealers want to do, and what we're kind of looking at, is the fact that they want to be able to compress markets. So as we get closer and closer to 6350, they want to be able to try to sell premium in order to try to keep that compressed as much as they possibly can. Obviously, there's things that can be out of their control. So a really decent day. Hopefully, we have a very strong close. Hopefully, we're able to close at these levels. And then tomorrow, when we see new placement from institutions starting off in the morning, you'd like to see them move higher as far as their re-rating, meaning buying higher, closer to the money puts, as well as selling out of the money calls.
It's like the S&P could hear us saying 6350 over and over and over again, because as you were talking, I was watching the board, and we're at 6350.51 right now. So it was incredible to watch, just sort of ticking right over that line as you were saying it. As far as volume goes today, what did that look like?
Yeah, if you're looking at the S&P 500 total composite volume, so like looking at all 498 components, adding their volume together, what does it look like? A little bit light today. So we have a nice little green day, but it is a little bit light. You'd like to see days like today coincide with very large volume in order to confirm the move. And we talked about this earlier this morning as well. What we did see before this breakdown that we saw Thursday, Friday of last week, we saw a nice little break out of this consolidation channel, but unfortunately that was on light volume, right? And then we started seeing selling on heavier volume. So days like today, you'd like to see green, but you'd like to see more buyers kind of stepping in, more activity to confirm the current price level here. We still have, once again, about 20 minutes left to go to the close or so. And so if we are going to see a significant market on close order imbalance to the buy side here, or even to the sell side, it probably could ramp it up. But it looks like we probably will eclipse or maybe touch what we saw yesterday as far as volume, which if you look at the last 3 months, you could say, okay, kind of healthy, but we want to get out of that seasonally slow period of volume just in general and start seeing that pick back up as we try to recover some of the losses from Friday.
Yeah, and certainly it's still a little